They ask me what the greatest lesson of my long life was, and they always expect some mystical incantation about discount rates or the perfect time to buy IBM. They want complexity. They crave a secret formula neatly packaged and ready to inject into their miserable portfolios. They are all wrong. The most important lesson, the one that turned two mediocre, slightly arrogant lawyers from Omaha into something approximating reasonable success, was not about knowing what to do. It was about knowing with absolute surgical precision what not to do. It was about the avoidance of stupidity, not the pursuit of brilliance. Most people trying to build wealth are climbing a greasy pole in the dark. They are focused on the top, ignoring the thousands of ways they are sabotaging their own ascent. They read the books, they study the charts, they track the quarterly earnings, and they still end up broke, or worse, miserable. Why? Because the modern world, especially this hideous digital one, rewards noise and complexity is the enemy of wisdom. You want the single greatest piece of advice I can give you? Here it is. If you merely avoid doing the truly stupid things, you will automatically beat 90% of your competition. And if you avoid them consistently, over decades, you will achieve results so far outside the average that people will start inventing mystical narratives about your genius. But they won't be right. We just avoided the traps they willingly walked into. This entire framework, which I call the SPICE Grand Failure Framework, is the actual secret behind everything Warren and I accomplished. It's the lesson I wish I had internalized when I was 30, before I wasted years on mediocre deals driven by pure ego. It is a philosophy of subtraction. It is the lesson that changed everything, and it's what I intend to lay out for you today, precisely and brutally. Now, I don't care about your attention. I'm too old for flattery and too wealthy for your clickbait economy. If you find some slight utility in hearing the grudging wisdom of an old man who has lived long enough to see precisely how many ways humans invent to screw themselves, then you are welcome to stick around. That is your call. The framework itself, the specific operational steps we used at Berkshire Hathaway to consistently veto bad ideas, will only be revealed toward the end of these thoughts, because, frankly, it takes this long to properly purge the bad habits you've accumulated. You need the context of failure before you can appreciate the elegance of simple avoidance. When Warren and I started talking seriously, and by serious, I mean the kind of continuous, iterative, intellectual conversation that lasts 50 years, we were both trying to figure out how to be great investors. Warren, being a proper student, was steeped in the teachings of Ben Graham. Graham taught us that the road to riches was paved with cigar butts, buying something extremely cheap, getting one last puff out of it, and moving on. That works, of course, until you realize that scraping pennies off the street is exhausting, intellectually demeaning, and ultimately limiting. We realized the true game wasn't finding average businesses at spectacular prices. It was finding spectacular businesses at merely average prices. But the shift wasn't just in the mathematical formula. The shift was internal. It was realizing that the biggest risk wasn't the stock market collapsing. The biggest risk was us collapsing. It was our own psychology, our own terrible wiring that was the primary threat to our long-term success. The fundamental human problem is this: we are wired for survival in the short term, tribal adherence, and instant gratification. The modern world, especially the world of compounding wealth, requires patience, detachment, and thinking in decades. These are incompatible forces. So, how do you fix a flawed machine? You don't try to make it perfect. You just put guardrails up to prevent catastrophic failure. The lesson that changed everything was realizing that inversion, thinking backward, was the most powerful tool ever discovered for financial sanity. The normal person asks, how do I become rich? The inverted thinker asks, what specific actions guarantee that I remain poor? The normal person asks, how do I make this investment perform better? The inverted thinker asks, what catastrophic failure modes could cause me to lose 100% of my principal? Once you have meticulously listed the paths to certain failure, you merely need to avoid them. It sounds too simple, doesn't it? It sounds like something your impoverished grandfather might have muttered, but I assure you, it is the highest form of operational genius. Let's take a simple example from the early days. We bought some textile mills early on. They were cheap. They met Graham's criteria. Warren could argue convincingly that the asset value was higher. Then the market capitalization. It was a classic cigar butt. But every time we invested in those old textile mills, it was a slow, painful amputation. We were constantly fighting against technological obsolescence, against unions, against cheaper foreign competition. We were putting out fires every single day. We were winning the battle of cheap price, but we were losing the war of intrinsic business quality. The lesson was learned brutally. When you buy a business with terrible economics, all the cheapness in the world won't save you. You are guaranteed a stressful, poor outcome. The avoidance lesson was, never buy a dying business just because it looks cheap on paper. The economics are stronger than your brilliant spreadsheet. This avoidance strategy is what distinguishes the true long-term compounder from the short-term speculator who merely gets lucky once or twice. And this brings us to the first pillar of the grand failure framework, the absolute veto on certainty. Most people seeking investment advice want certainty. They want a guru to whisper tomorrow's winning stock into their ear. They want a guarantee. This craving for certainty is the first great path to ruin. The world is complex, non-linear, and messy. If someone is offering you certainty, a surefire system, a guaranteed return, a predictable chart pattern, they are either lying to you or profoundly deluded. They are selling a false religion. The wisest people I know, and Warren is at the top of that short list, are comfortable saying, I don't know. We have built our empire by knowing where the edges of our competence lie and staying 5 miles inside them. If we can't understand the competitive dynamics of a business in 30 minutes, we discard it. It doesn't matter if everyone else on Wall Street is making money off of some opaque derivative. If we don't understand the machine, we don't touch the controls. That's avoidance number 1. Avoid anything you cannot fully explain to a bright 12-year-old. Now, this seems obvious, yet millions ignore it every day. They get seduced by the latest technology or the most complicated financial instrument because they believe complexity equals sophistication. I assure you, sophistication often means merely an elaborate route to disaster. Think about the incentives here. The people selling you the complex products, the investment bankers, the hedge fund managers, the financial media pundits are paid handsomely for complexity. They aren't paid for simple, long-term common sense advice. Their livelihood depends on you believing that their proprietary spreadsheet model is necessary for your survival. They must inflate the perceived difficulty of the game. The avoidance lesson is avoid complexity. Complexity is where the frauds hide and where common sense dies. I've had to watch countless brilliant men, lawyers, mathematicians, engineers, ruin themselves because they thought they could outsmart the simple math of risk. They thought their intelligence was a protective shield. It's not. In fact, excessive intelligence without a strong tempering of humility is often an accelerator towards stupidity. If you are smart, you can invent elaborate, convincing reasons for doing something monumentally foolish. A dumb person wouldn't even have the mental horsepower to create the justification. If you are following any of this grudgingly offered wisdom and perhaps seeing the shadow of your own mistakes in these observations, then perhaps you might signal that to the system. It helps the quiet truths of inversion reach those who still cling to the fantasy of instant riches. It helps separate the serious minds from the noise. Let me tell you about the second pillar of avoidance, and this one is purely psychological: the avoidance of consistency and commitment bias. We humans are wired to be consistent. Once we make a public pronouncement or even just a private decision, our brains desperately try to reinforce it, even when the data changes. This is the consistency and commitment bias, and it is a grave robber of wealth. Imagine you bought a stock. You told your wife, your friends, and maybe even posted about it online, outlining your brilliant thesis. 6 months later, the competitive landscape shifts. The management makes terrible decisions, and the thesis is shattered. What does the average well-meaning fool do? They double down. They defend their original, flawed decision with increasing ferocity. They refuse to admit they were wrong because admitting error feels like losing face, like a psychological defeat. But in the game of compounding wealth, admitting error is the highest form of intelligence. It is the cheapest insurance you can buy. Warren and I made mistakes constantly, but when we realized we were wrong, whether it took 6 minutes or 6 years, we corrected quickly and moved on without remorse. We didn't allow the sunk costs, the time spent on research, the money already invested, to dictate the future decision. The classic example: selling the good stuff too early. People sell the winners, which are still compounding beautifully, to offset the losses from the garbage they should have sold a year ago. They are emotionally attached to the losers and prematurely harvesting the fruit of the winners. This is pure, unadulterated stupidity, driven by the need to feel consistent about their initial bad choices. The avoidance rule here is brutal. You must train yourself to treat past decisions as irrelevant data points. The only thing that matters is the future rate of return and the level of risk from this moment forward. If you wouldn't buy it today, you must sell it today regardless of how much you paid for it yesterday. And this leads us straight into the concept of temperament. I often say that temperament is more important than intellect, and I mean it. Why? Because temperament governs your response to pain, and the market is specifically designed to inflict pain on you precisely when you need maximum mental clarity. If you don't have the stomach to watch your portfolio drop by 50% without needing to sell everything and hide under the bed, you are structurally unfit for serious investing. You have not avoided the temperament trap. The great avoidance strategy is maintaining detachment. You must avoid the emotional roller coaster when the market is euphoric. You must avoid the feeling of needing to participate, greed bias. When the market is terrified, you must avoid the panic, fear, loss, aversion bias. We are constantly talking about the concept of moats in business, the durable competitive advantage. But few people talk about the moat of temperament. That moat protects the investor from the most insidious competitor of all, themselves. I've spent my life watching smart people destroy their fortunes because of a total lack of emotional discipline. They chased hot stocks, they borrowed too much money right before a panic, or they became envious of their neighbor's lucky Bitcoin windfall. Envy, incidentally, is a mandatory avoidance subject. We must define the role of envy. It is one of the 7 deadly sins for a reason. In the financial world, envy doesn't just make you miserable, it makes you stupid. When you see someone else getting rich quickly, you become impatient. Impatience leads to straying outside your circle of competence, borrowing too much money, and chasing high-risk garbage. The avoidance strategy is simple. Assume everyone else is probably lying about their success. Focus entirely on your own durable process and calculate your own intrinsic value, not theirs. Let's move on to the third great pillar of failure that must be inverted and avoided: the avoidance of confirmatory evidence and authority worship. When people form an opinion, they immediately begin a desperate search for evidence that proves them right. They don't seek truth, they seek validation. This is known as confirmation bias, and it cripples analytical thinking. If you believe inflation is transitory, you will only read articles and listen to pundits who confirm that view. If you believe the economy is about to collapse, you will only seek out the doom peddlers. You end up living in a little echo chamber of your own making, where your flawed initial premise is continuously reinforced until it becomes an unshakable dogma. The lesson that changed everything, the lesson of inversion, demands that you deliberately seek out the smartest people who disagree with you. You must try, with every ounce of your mental energy, to disprove your own thesis. If your thesis survives the attempt to murder it, then and only then should you proceed. This is why Warren and I were so valuable to each other. We weren't yes men. We spent decades ruthlessly tearing apart each other's ideas, searching for the fatal flaw. That friction, that deliberate search for disconfirmatory evidence is what separates investment success from intellectual masturbation. And coupled with this is the avoidance of authority worship. Just because someone has a title, a PhD, a managing director, or a large following on some digital platform, does not mean they are competent or even sane. The world is full of highly articulate, highly credentialed fools. The avoidance rule: never take advice from a paid intermediary whose incentives are not perfectly aligned with your own. If a broker gets a commission based on how frequently you trade, guess what? He will encourage trading. If an advisor is paid based on the assets they manage, they will encourage maximum asset accumulation, regardless of whether that asset is right for you. Their incentives create bias, and bias creates financial failure. You must internalize this truth and avoid being charmed by the suit or the credential. Always ask, where does he stand? What is he paid to do? That single question will filter out 90% of the bad advice available to you. Now, let's talk about the specific architecture of ruin, moving deeper into a grand failure framework. There are 2 things people consistently fail to avoid that guarantee mediocrity: excessive leverage and failure to understand opportunity cost. First, leverage, debt, borrowing money to magnify gain. I have seen more people destroyed by leverage than by any other force in finance. And they are often smart people. They look at the math and say, if I can borrow money at 5% and generate 10% returns, I'm a genius. What they forget is the nonlinear, unpredictable nature of history. They forget that the margin call often comes at the worst possible moment, when prices are collapsing, liquidity is drying up, and everyone is panicking. they ignore the pain threshold. Leverage is a double-edged sword that cuts deeply into the fool's hand when he least expects it. Warren and I have avoided it like the plague for decades, maintaining huge cash reserves. Why? Because avoiding leverage ensures that we survive long enough to take advantage of the times when everyone else is destroyed by it. The avoidance lesson on leverage: never use a level of leverage that can result in permanent loss of capital, no matter how certain you are of the outcome. We decided early on that a 100% chance of a modest success is vastly superior to a 90% chance of a massive success, coupled with a 10% chance of total ruin. That 10% risk of ruin, magnified by leverage, will always find you eventually. Second, the failure to understand opportunity cost. Opportunity cost is the road not taken. It is what you give up when you choose one course of action over another. This is an essential concept to avoid being a busy idiot. People confuse activity with achievement. They are constantly shuffling their portfolio, chasing small incremental gains, moving from one mediocre idea to the next. Every time they invest in an average company, they are sacrificing the opportunity to invest in a truly spectacular company when it becomes available. Warren and I structured our entire investing approach around the idea of avoiding activity. We practiced radical patience. We waited, sometimes years, for the absolute, unquestionable fat pitch to come across the plate. When you have a few truly spectacular ideas, when you have a Seaboard, a Coca-Cola, a BYD, you don't need 50 mediocre ideas. In fact, 50 mediocre ideas distract you from the few great ones. The avoidance lesson: avoid the lure of constant activity. If you can't find a deal that is 10 times better than the second best deal on your desk, you should probably just sit on your hands and wait. Doing nothing is often the wisest action available, and it is the hardest thing for modern man to do. Now, let's talk about the specific human behaviors that must be inverted and eliminated from your intellectual toolkit. I call these the 4 horsemen of financial misjudgment. Avoiding these 4 is the core of the operating manual. The 4 horsemen of financial misjudgment. 1. The avoidance of reciprocity misjudgment. We are wired to return favors. If someone gives us something, we feel obliged to give back. Salesmen, brokers, and con artists exploit this relentlessly. They give you a small favor, a nice gift, or even just an excess of courtesy, hoping you feel obligated to sign the enormous contract. The avoidance strategy is ruthless. You must refuse the small gifts, remain skeptical of excessive courtesy, and treat every interaction purely as a detached business transaction. Never let a small gesture obligate you to a massive mistake. 2. The avoidance of social proof misjudgment. We look around to see what others are doing, especially when we are confused or stressed. If everyone is rushing into a fad, whether it's tulips, housing bubbles, or dog coins, the average person assumes they must be missing something and jumps in too. The crowd is almost always wrong at the extremes. They are emotional, late, and prone to panic. The avoidance strategy: when the crowd is screaming, cover your ears. When consensus on an asset reaches 90%, run for the hills. We gain our edge by being contrarian, not just for the sake of it, but by being logically independent. 3. The avoidance of deprival, superreaction syndrome, loss aversion. This is perhaps the most destructive force of all. Loss aversion is the intense, sometimes violent, psychological pain associated with losing something you already possess, which is often twice as powerful as the pleasure of gaining an equivalent amount. This is why people hold on to losing investments forever, waiting for the mythical moment when they can just get back to even. They are prioritizing the avoidance of psychological pain over the maximization of future capital. The avoidance strategy: treat every loss as an unavoidable tuition fee paid to the market. Cut the losses quickly. Never let the fear of admitting a loss prevent you from seizing a future gain. 4. The avoidance of incentive-caused bias. This is the single most important lesson of my life, the one I spent years hammering into Warren's head until he finally understood it completely. Show me the incentive, and I will show you the outcome. People respond to incentives, always. If you want to understand why institutions or individuals behave poorly, look at how they are paid. If the incentive system is flawed, the behavior will be flawed. Period. The avoidance strategy for this is not about changing other people's incentives. It's about avoiding systems where incentives are toxic. Avoid commission-based advisors. Avoid any business partner whose share of the upside is vastly larger than his share of the downside. You must build your life and your portfolio exclusively around systems and people whose goals are perfectly aligned with your own. If the incentives are wrong, the outcome is guaranteed to be wrong. This is a law of nature, not a theory. This inverted approach, the focus on what to avoid, is why we spend so much time studying history, psychology, and the great catastrophes of human existence. We are not looking for the blueprints of success. We are looking for the common denominators of failure. Let's talk briefly about history and why the avoidance of historical illiteracy is critical. People seem to believe that whatever is happening right now is somehow unprecedented. They think this time is different. I assure you, it is rarely different. The names change. We swap South Sea Bubble for dot-com bubble or 1929 margin trading for modern crypto leverage, but the core human psychology remains identical. Greed, fear, and excessive optimism are timeless forces. The avoidance lesson of history is simple. If something sounds too good to be true, it is. If everyone is getting rich overnight, you are already too late, and you are participating in a delusion. History doesn't repeat itself exactly, but it often rhymes. You must avoid the mental laziness that makes you assume the rules of finance have suddenly been suspended just for your benefit. I remember Warren came to me years ago, maybe late 1980s, concerned about a specific type of investment that everyone in New York was touting. It was complex, requiring endless financial modeling, and the returns looked superficially fantastic. I listened patiently, watching him build this complicated mathematical castle in the air. When he was done, I simply asked him one question. "Warren," I said, grumpy as ever, "when was the last time a complicated deal requiring hundreds of pages of documentation and dozens of bankers turned out to be a better investment than a simple, wonderful business run by honest people?" He paused. He couldn't name one. The avoidance lesson was immediately clear. Avoid complexity and unnecessary intermediation. If the deal needs a library of documents to explain it, the risk is buried somewhere on page 400, and you will not find it until it's too late. The truly great deals, the ones we made a fortune on, were simple enough to sketch on the back of an envelope. The lesson that changed everything fundamentally was the continuous dedication to clearing the mind of rubbish. We are like gardeners. We don't spend all our time planting seeds. We spend most of our time ruthlessly pulling the weeds. What are the weeds in modern life that guarantee failure? 1. Avoidance of constant news consumption. The media needs your eyeballs, and fear and excitement sell eyeballs. They sensationalize the mundane and invent crises where none exist. Constant intake of financial news creates noise, anxiety, and the compulsive urge to do something. If you are constantly checking the stock price or reacting to daily headlines, you are ensuring a short-term, emotionally driven, poor outcome. The avoidance rule? Read less, think more. Set aside 90% of the daily noise as irrelevant static. 2. Avoidance of intellectual laziness. People want the answer delivered in 280 characters. They want the outcome without the grueling process of understanding the inputs. But true understanding, the kind that allows you to hold your nerve during a crisis, requires deep, focused study across multiple disciplines: history, physics, psychology, and engineering. If you rely on superficial summaries, you will only grasp superficial opportunities. The avoidance rule: commit to lifelong reading and continuous cross-disciplinary learning. Stop reading finance books written by financial people. Start reading biology and psychology. 3. Avoidance of toxic people. Your personal ecosystem matters profoundly. If you surround yourself with speculators, cynics, or people prone to excessive risk-taking, that behavior will eventually rub off on you. You become the average of the 5 people you spend the most time with, both professionally and intellectually. If those 5 people are constantly chasing quick money and gambling, you will adopt their failed habits. The avoidance strategy: seek out ethical, patient people who have achieved success through slow, durable compounding. Sever ties with the impatient, the envious, and the cynical. It boils down to this: the true genius of the lesson that changed everything is the concept of negative knowledge, via negativa. It is easier to know what to avoid than to know precisely what to do. It is easier to know the reasons why businesses fail than to know which specific business will win the technological race next year. It is easier to know the paths to financial ruin than to know the exact path to spectacular riches. If you focus on avoiding the known causes of destruction, leverage, envy, complexity, consistency bias, and short-term thinking, you automatically elevate your standing significantly. By merely removing the obvious traps, you have positioned yourself for success when the inevitable opportunities arise. This creates what I call favorable tailing events, situations where the tide is moving so strongly in your favor that your patience is violently rewarded. Now, I promised you the specific operational steps, the grand failure framework that Warren and I used to veto bad ideas. This framework operationalizes inversion. It forces you to look for ruin first. We applied this filter to every single major investment decision, and it's why we rarely suffered a catastrophic loss. The grand failure framework consists of 5 non-negotiable questions that must be answered negatively before proceeding. If the answer to any of these is yes, you stop immediately. It's a ruthless process. The grand failure framework: 5 veto points. Veto point 1: does this require extraordinary management? If the success of the investment relies heavily on a single charismatic genius or requires management to consistently execute highly complex maneuvers, we veto it. Extraordinary management is rare, temporary, and difficult to replace. We seek businesses so wonderful that they can be run competently by an average idiot. The avoidance strategy: avoid reliance on individual brilliance. Seek structural superiority. Veto point 2: can the failure mode result in permanent loss of capital? This is the leverage test extended. If the business model, competitive dynamics, or capital structure means that the downside involves losing 100% of the invested capital, it is vetoed. We are obsessed with survival and staying in the game. We seek scenarios where the downside is limited to a temporary setback or a reduced return, never absolute ruin. Veto point 3 is the decision being driven by incentive misalignment. This forces us to check our own biases and the biases of the counterparty. Am I buying this because it's a genuinely great deal or because I feel obligated to deploy capital? Incentive-caused bias. Is the seller pushing this because the transaction structure benefits them disproportionately? If the underlying incentives feel murky or asymmetrical, we veto it. Never proceed where the interests are not aligned. Veto point 4. Is the competitive moat actively shrinking or non-existent? We avoid businesses where the competitive landscape is constantly shifting, where technological risk is paramount, or where barriers to entry are low. We look for predictable, durable barriers, the moat. If we cannot articulate exactly why this business will be earning high returns in 10 years, even against determined, well-capitalized competition, the business is a trap. We veto it. We avoid innovation for the sake of it. We seek durability. Veto. Point 5. Does this decision require haste, complexity, or a high degree of confidence in macro forecasting? If we are being pressured to act quickly, if the math is too complicated for a human being to verify quickly, or if the success of the deal relies on our accurate prediction of interest rates, war, or recessions, we veto it. We avoid predictions, complexity, and urgency. Urgency is almost always the seller's leverage, not your opportunity. This is the lesson that changed everything. The relentless, unforgiving application of these 5 veto points. By avoiding the common traps, the need for speed, the reliance on heroes, the risk of permanent loss, misalignment, and competitive fragility, we ensured that the few decisions we did make were overwhelmingly safe and robust. The market rewards inaction, tempered by ruthless patience. It punishes the restless, the greedy, and the fearful. So if you ask me, what is the single most important lesson? It is that the highest form of financial wisdom is simply knowing where the landmines are buried and stepping around them. Don't seek genius, seek reliable survival. And survival, practiced consistently over 80 years, looks exactly like genius to the short-term fool. Go forth, invert your thinking, and focus on the terrible mistakes you must avoid, rather than the lottery ticket you hope to win. That's the only reliable path to lasting wealth.